Welcome to Investors Hangout once again. This is our fortnightly interaction in which we try and answer your questions, talk about one of the top of your mind issues that crossing your mind on investments, particularly about mutual funds, and once in a while we get a special guest, and today we have with us Aditya Birla Sun Life CEO A Balasubramanian. I've known him for all these years in different roles, and he's a CEO now. We are going to talk about some of the things which I think he'll be knowing very intimately about, and this hangout with Bala is first I'm curious to know something from you, Bala, which is, what do you attribute Aditya Birla Sun Life? You have been going up the ranks on the AUM, but that apart, what will you attribute your performance to? Because performance has steadily improved over time across a wide array.
Yeah.
So what will you attribute? I still tend to believe that when you do well, people put money. So at the heart of it, it's performance. What will you attribute your performance to in such a broad spectrum way?
I think your observation is pretty valid. The way we have built the business last 4 or 5 years. One, the business has to be built with a strong connect with the customers. That's something has been one of the big focus that we brought in order to build our size. That connect with the customer means both our distribution partners as well as the investors. Second is we need to have very high clarity in terms of our communication. And third, there has to be a consistency in everything that we do.
Okay.
So I call it as a 3 C's. So that's something which we clearly brought a lot of high focus last few years. And the other area where we also stepped our focus, at the end of the day, mutual fund business is driven by people, performance as well as the process, and these three men actually key pillar everything that we do. While we coined these words, which is P's, 3 P's and 3 C's from the investment performance point of view, but ultimately we realized that it is applicable for everything that we do, whether it is engagement with distributors or driving the investors' communications, or maybe carrying out the operational efficiency, so on and so forth. Everywhere we felt that this consistency and clarity in terms of what we are doing is always extremely important in building the business model. And finally, in every market, when we started expanding the reach, we started measuring our success in terms of measurement metrics, but with a clear goal that is given to all employees, that our measurement metrics in terms of our success should be done on the basis of how I increase my market share, how I increase my customer additions, how actually well I'm engaged in terms of connecting with the distributors as well as the customers. This is where we start measuring the success. I think the combination of all these factors, which includes investor education series even that we started doing everywhere. I think a combination of multiple things led to us perform better than the what we used to do in the past, and also is either line with
continuous improvement on all the things that you do on these 3 P's and 3 C's.
Exactly.
Okay.
Yes.
As a strategy, the SEBI's rejigging, and you are an old company and you acquired the Alliance Fund, and then you acquired the Apple funds, and so you had a wide array of funds, and this you have been part of SEBI's Mutual Fund Advisory Committee too, and this thing happened.
In fact, I think we did it together.
Yeah, of course, I have been almost like a fixture there for a while, at least in this area of the reclassification exercise. But how difficult was this exercise for you internally to do it? And are you able to, let me get an answer to this, then I will actually ask you what is something else which is crossing my mind.
See, as far as the consolidation of scheme concerned, as you rightly put it, we as a fund house had 3 funds takeover in the last 25 years. We started with the Apple mutual fund, then became Alliance, then finally we did ING.
Yeah.
So 3 mutual fund schemes when we bought, all the schemes came on to us. That time the regulatory framework was such that all the schemes can come on board to the acquiring fund, and then I can continue that fund for perpetuity.
So plenty of
duplications used to be there. Of course, we also we left it and continued to run with a lot of duplicity. And over a period of time, even before the regulatory direction that came, we've been undertaking this merger exercise wherever there's a duplicity, wherever we think that we can't grow the size, and so on and so forth.
For your own efficiency.
For our own efficiency.
Or role description.
Exactly. We started actually doing the merger of the schemes. So therefore, that experience was there with us. Second is when that new guideline which came from SEBI, of course, it so happened that I was also part of that SEBI committee on the consolidation of schemes. Even you were part of the committee. And that, I think, when we started doing it, we also felt there is a need to change a few schemes of documents, etc. In order to ensure that we get aligned fully to what the scheme is supposed to deliver with respect to the investment objective. And accordingly, wherever there is a need for changing the offer document objective from fundamental attributes that we call it, if that had to be changed, then we said we have to change it. So that's why I think we did it. So I would assume the whole exercise, though it did have some bit of challenges, more in terms of convincing internal money manager especially, and make him understand the change that is needed, and therefore how he has to adjust the portfolio. I think beyond that, I think all the work that are gone behind is ensuring right communication goes, and then we change the offer document in such a manner. We don't
no, but I'm primarily concerned about, when you were merging the scheme, a small fund merging with a large fund, or a large fund merging with a small fund.
Correct.
Combining the asset weighted, the weighted average, performance history, making customers. So, how difficult was it internally for you to realign?
It was, of course, one, doing the right identification, and second is in terms of which scheme has to get merged where, and third is actually the some other thing that we have created in all these years. Suddenly we have to let go some other thing. I think the challenge was actually letting go some of the schemes, despite we having good performance, despite the concept being good, despite the money manager being emotional to manage those kind of funds, smaller in size, but it has to get merged with the bigger funds. These were some of the challenges which were there. So, but apart from that,
so you had to let go some of the beautiful performance on small funds which were no longer possible to run independently.
Exactly.
Now I have a question which is RBI recently hiked the interest rates, and you have been an old-time fixed income fund manager. I know your height lies there. I keep getting your messages on key events. So what is the outlook now? What is the outlook for fixed income? This is one question which I will be very curious to know in great detail in terms of what to expect, and also explaining the mutual fund classification for fixed income, because that has created a different kind of opportunity and very fine definitions which investors can choose.
Yeah, I think the way it's the interest rate cycle is moving in India. So after 4.5 years of either falling interest rates regime or a stable interest rate regime, we are actually now getting into the rising interest rate scenario.
You think it is now the start of the rise, or
yes, I think it's the beginning of rise. But the question
is not a one-off thing.
It's not a one-off things.
Okay.
Definitely, we're on a rising interest rate scenario from the policymakers' perspectives.
Okay.
I think the interim interest rate policies, which is the repo rate, what we call it from a Reserve Bank of India point of view, is used as a signal on rising interest rates. The reason actually why we also feel that there is a high probability that 50 to 70 basis points rate hike could happen in the next 1 year time frame. One is the inflationary scenario, the trajectory is changing from 4 to 4.5 to 4.5 to 5.25.
Okay.
Mainly led by oil price going up, and second is the domestic inflation, especially on food prices, may probably pose a threat, and so on and so forth. And second is the global interest rates have been continuous on the rise, especially US has been hiking interest rates. We already seen emerging market rising interest rates. And third, I think we'll probably join the bandwagon in terms of rising interest rates in Europe. So in a global interest rate environment, when it is on the rising path, and India of course cannot be different from rest of the global market.
No, our inflation figures can be very different, and we could only be a little higher.
Correct. Yep. So therefore, that is being the case, I think the rates is on the way up. Even from money manager's point of view, in this kind of scenario, I think the point what you mentioned about consolidation of schemes, at least the consolidation of scheme within the fixed income, so now is bringing some bit of the boundary in which money managers have to operate. In a rising interest rate...
But 16 kind of funds now possible.
Yes.
And in a legitimate way.
Exactly.
Of course, we at Value Research were facing a lot of problem, because earlier any fund could do anything and it will change colors over time. So for us, classification exercise was a constant challenge.
Correct.
Now things have been very well articulated in terms of numerically what the fund is supposed to do. But how will how will an investor choose of these 16? Take me through this whole process that, of your 16 funds, just tell me about 5 funds. So what one should be doing? Liquid and ultra short term bond funds are very clear.
See, I think one of the big innovation that we have brought into the fixed income consolidation is to clearly mention in the scheme name, it's actually supposed to be the reflecting what is the underlying objective of the portfolios.
Okay. Okay.
I think the names that it took, liquid fund means name itself explains that. Which is liquid fund, ultra short term fund, credit risk fund, corporate bond fund, PSU and short term funds and medium term fund. I think the name actually suggests. Second is whatever the underlying objective of the schemes. What are the underlying objective of the schemes? At the end of the day, every money manager is supposed to take a risk either by investing in bonds that has got say 10-year maturity or 20-year maturity, or is supposed to invest only in bonds which is mix of government bonds and corporate bonds, or he has to invest in between AAA and AA and AA minus kind of things. That's I think whole objective of him. At the end of the day, he is supposed to take interest rate risk.
Mix it up to optimize the return.
To optimize the return to the investors. And that kind of risk which the fund money manager is taking in each of these category is clearly defined. What is the path I think he should take in terms of duration, whether it's average maturity or duration, whatever you call it. And that's very clearly defined for each of the schemes. Therefore, the money managers cannot go beyond that. So, at the same time, you cannot go beyond a certain lower number.
Below that.
Therefore, that's I think the boundary. Now, for
of course, you have all the flexibility with the dynamic bond fund and
those flexibilities are there. Therefore, with
the flexible mandate itself.
Exactly. That of course again you have separate schemes. Whether all the funds will have the same flexibility, no.
Yeah, sure.
But they all operate in a certain boundary in order to have a higher predictability.
How will somebody choose of these 16 funds? Because technically, from a fund manager's point of view, his boundaries are set.
Correct.
But my needs are very straightforward. That I need money for few days. I need to invest my money for a large sum of money for few days, few months. I don't want to take chances, but I want to optimize my return, which is the way out.
I think clearly.
How do you guide an investor to pick 3 or 2 of the 16?
Yeah, I think clearly from an investor's point of view at large, in the fixed income space, is to one protect his capital.
Yeah, sure.
And second is he gets a return which can be potentially be higher than what he gets in the bank, either FD or the bank savings account.
Sure.
And if you look at from the mutual fund product point of view, there are funds which are in the low duration category. I call it the low duration category. Anything which is less than 3-year duration, generally the risk associated with that kind of investment is relatively low. Therefore, for anybody who wants to choose fixed income schemes within the mutual fund space, I think is more safer to invest in funds which invest in as low as 90 days to as high as about 3 years. And that fund actually relatively carries a lesser interest rate risk. At the same time, it gives a predictable return. And anybody who wants to play beyond that, suppose he says, I'm a risk taker, but I want a higher return, I'm expecting interest rates to go up and down, or I'll give the money manager actually
I don't mind that, and
he doesn't, you don't mind, then actually go beyond that 3 years curve. The other fund, which of course all of us in the mutual fund industry, including Birla Mutual Fund, is looking at promoting, is actually invest only in the credit funds.
Okay.
So we go and choose a credit which will go below AAA. We go down to as low as about sometime even BBB kind of investment. But as long as those investments are well accepted within our credit norms from a
you do the diligence
from a due diligence point of view,
or you do a structuring or a design so that you guard your interest.
Exactly. Such kind of schemes I think mutual funds have been offering, and we have been pioneer in that space in terms of picking credit which can potentially generate a higher return for the investors. At the same time, they hold the potential of upgrades. And we have seen many such kind of cases.
Sure.
Such kind of funds can also, which is called an accrual fund, but mainly driven by the credit. There are accrual funds which invest only in corporate bonds.
Okay.
I think from investors' point of view, they can choose both the schemes.
So that is the way to optimize the return as compared to fixed deposits, and
exactly
without assuming some great risk.
Exactly.
Let me now get on to the questions that we have got for you as well as for me. But the first question comes from Rameshwar, which is, two of the prominent Birla funds have changed their names. Birla Balanced 95 has become Hybrid 95 Fund, and Top 100 is now called Focused Equity. Is there a change in strategy too? What should investors do?
No, as far as the Birla Hybrid 95 concerns, absolutely no change in the portfolio strategy. That's except name has been changed.
Name has no longer balanced, and it was not a balanced fund even earlier.
Correct. So therefore, that one which I think we're gone by the SEBI guidance.
It remains a 75% equity, 25%.
One good thing from the customer point of view, all fund houses will have a hybrid as one of the nomenclature. Therefore, it's easy to compare. From portfolio manager point of view, life remains the same.
Yes.
As far as the top 100 concern, though we'll of course continue to have exposure to top 100 companies. The one which is changing actually from a money managers point of view, investing in 45-50 stocks from the top 100 companies, now will be more focused.
Okay.
So
we'll have a large cap focus.
The large cap focus fund.
What is the maximum number of stocks it will have now?
Maybe anywhere between 30-35 stocks, and that can vary from 25 to 35.
Okay.
But the single stock exposure is ranging from 3 to 5%, and that's the kind of focus that comes in.
Okay.
So not really the focus is not there. Even at top 100, the focus was there. That itself very clearly.
So now you have clearly slotted it in that category allowed by the
category.
Okay.
That's it. Otherwise, you don't see too much of change, I think, happening from the offer document perspective.
Okay. Here is a question, Nand Kishore. It is believed that once the economy mature, ETFs are better than active funds. Please guide in this regard. For investors having a long-term horizon of 5 years, is it the right time to invest in ETFs? Yes, that is generally the hypothesis, but I think we are far from gaining maturity. And I think this is largely applicable to the developed world, where because I'm not very sure that active funds are going to wither away. Indexing is not going to be mainstream in India for a while now, because it works in developed economies for a different reason. The whole economy is market oriented, and all parts of the economy are exposed to it's a free market economy across. Not as much in India, not as much in many other underdeveloped markets or developing markets.
Correct.
A good part of our economy is still public sector, or so that leads to or the kind of distortion that we see in the economy. So we are far from that. That apart, the last 10 year, 15 year, 20 year, or even 5 year performance of actively managed fund as compared to index is phenomenal. The wide margin by which the actively managed funds beat the index is something which investors should not lose out on. So I think we are far from being an index driven investment as an attractive option. Hold for now. Maybe it happens in 5-10 years time, I don't know, but as of now, indexing is far from being mainstream investment avenue for investors. Now this is a question from Mahendra Kumar Bala, and I think you should answer this. How good are arbitrage funds?
Arbitrage fund is good fund. I think the risk that is being carried on the investing in equity, because it's the more of hedging in nature lies in the arbitrage fund. The relative risk is low. I think it's the least risk from the underlying portfolio construction point of view. From the return point of view, I think more and more the size grows. Of course, the return comes down actually quite significantly. Even today's market, the
arbitrage opportunities
are very less because wider participation. So everybody actually is looking at hedging their exposure. What you buy in spot, you sell in the future. Therefore,
so arbitrage by its very design is self-cannibalizing.
Correct.
If there is anything where there is a difference, more people will board that, and that itself will kill it. So,
exactly.
So is there a possibility that these arbitrage funds will be very difficult to manage in its current form?
Not, I think it will not be. Only thing
because you always have a fallback that they will be investing in money market securities.
No, that of course it has about 35% we invest in money market securities. 60% will still have to be invested in equity.
For its treatment as
an equity fund. And having said that, the more and more money start chasing the arbitrage opportunity. I think it's natural to assume, assuming scenario, it gives about say 7% as of today arbitrage opportunity. As the fund size grows and more people start looking for those opportunities, 7 will become 6 will become 5.
So it will become more efficient and
more efficient from market point of view, but definitely from return point of view, higher the size, expectation of lower the return has to be there.
Has there been a situation that the market has become more volatile, so there are more arbitrage opportunities available?
No, not necessarily. At times we do see the reverse arbitrage. Sometimes if the market is bearish, people may go short in the market.
Okay.
So therefore the future will go at a discount and the spot will pay at a premium. Therefore there are times where you may see the opportunity doesn't exist.
Okay.
So that is one of the reasons.
Completely dry up. So
it can
it's not negative.
Correct. Yeah. But sometimes the opportunity comes in the form of you can lend your stocks. Sometimes you lending your stocks which is lying in your portfolio. For 3 days or 7 days, you can lend your stocks and get some extra return on that. Sometimes 100% buyback opportunities
how meaningful is that opportunity?
It's a pretty decent. I think you need to be more efficient in that space.
So it increases your return on that particular investment by 10 basis points?
By a few basis points. Few basis points. But as a category, somebody who is extremely conservative, doesn't want to take a risk on either on liquid fund or money market or on the debt funds, or doesn't want to take risk on equity, then he can as well park his money in arbitrage fund and he'll be happy with whatever the return comes there.
Okay, let me understand one thing, that I want to invest money for 15 months and I have the choice of investing in an arbitrage fund versus a liquid fund. The advantage is that I choose an arbitrage fund because it will be treated as equity, 15%, 10% long-term capital gains, assuming the change scenario.
Exactly.
Is there a possibility that when I invest in this arbitrage fund, there is a possibility that it will not be an arbitrage fund because it was not able to get that arbitrage opportunity and it had to turn into a liquid fund because of compulsion?
It doesn't look like, actually. I think given the past so many years of experience in the market,
that looks unlikely.
It does looks unlikely. I think arbitrage opportunity always prevails, except that I need to be happy with 4, 5, 6 at times 4, at times 5, lower return. That's it.
But
I don't think it's going to disappear.
The character won't change. No, because I'm concerned more about guarding my interest in terms of I was choosing it because it was an equity fund and it did not become one.
I don't see that as a big risk actually as of now.
Okay, I have got a very basic question, which is, Sanchita is asking, where should she keep her retirement money to get steady monthly income? In short-term debt funds or large cap equity funds?
I think for retirement, the best is to actually look at the fixed income funds, which are more in the nature of either a corporate bond fund or credit risk fund or medium term fund.
Yeah, the accrual
which
fund,
is accrual kind of fund, where you put your money and if your monthly return expectation is roughly about say 7-8%, given the fact where the current interest rates are, you should actually withdraw to the extent of 8% in order to make it more tax efficient, as well as leave something on the investment for you to get the little bit of capital gain. Therefore, the retirement is easy to plan as long as your expectation of withdrawal is kept very meaningful and in relation to the current deposit what you will get. Then it becomes tax efficient.
So don't choose the dividend plan of the debt funds. Choose a withdrawal plan that will be more tax efficient.
Exactly.
Because if you are taking the return in the form of a withdrawal, to the extent that the fund is earning, it will have very low tax implication because it will be treated as taking your money back, and the returns will remain in the fund, and it will be tax sheltered and deferred. Of course, you will be liable for taxes at a much later
marginal tax will come.
Marginal tax,
which is
very
basically on the withdrawal. There is an element of capital
appreciation.
There is an element of appreciation. Yeah. The appreciation is so small, you will end up paying very little tax.
So the lowest tax incidence that is possible.
Exactly.
So this is a new thing which has come about, that don't choose your dividend plans even with your debt funds.
Exactly.
Earlier the situation was different. What is the tax treatment of international mutual fund? They are almost like the debt funds. Indexation after 3 years, because the 1 year long term capital gains tax of 15%, and below that short term capital gains tax of long term capital gains tax of 10%, and short term cap for holding of over 1 year, and short term capital gains tax of 15% for investment of less than 1 year, is applicable only on domestic equity, and domestic equity is defined as a fund which invests at least 65% in domestic equity stocks. So international funds, I don't know, Bala, you heard this news that there will be international companies which will be listed in India, and they will be subject to the securities transaction tax and all that. That is the definition of the tax. So once those companies are listed, and if somebody is investing in those stocks, will it be treated as an Indian stock?
It will be,
yeah.
It will be, because it is listed in Indian market, and therefore it will be treated as a.
So look for some of those interesting avenues. An international fund, but you can buy those stocks because they will be listed in Indian market. Things can change, but as of now, this is the status. The treatment of international fund is like that of a fixed income fund. Now Supriyo has this question which I think is only for you. Where can I park my money for 2-3 years to get better return than fixed deposits?
I think 2-3 years clearly the fixed income funds again, as I mentioned earlier,
tax efficiency itself becomes a big turning point.
So that's something which is which is the accrual fund or corporate debt fund. Another category which is also emerging with the interest rates having now gone up in the recent past, which is an FMP. Fixed maturities plan is most efficient from the investor's point of view, and the predictable return is also very high. You don't take the volatility of interest rates movement in that. and at the end of 3 years it matures automatically.
Yeah.
It doesn't actually, it's not an open-end fund where it just goes on and on. If somebody has got a very definite time horizon of 3 years, then it could be worthwhile locking into the FMP, except does not have the liquidity, which otherwise an open-end fund offers you in case of an emergency.
Are fund companies, enabling any kind of borrowing against those FMPs?
Not really. I think, of course, listed in the stock market, but listing is there, but you don't find the liquidity in listing.
There is no liquidity. Yeah. So, if you don't have any interim liquidity requirement, you are unlikely to need that money before 3 years, and you are sure about 3 years and more period for which you will be making this investment, go for FMPs. Now, this is one question which I keep getting all the time from all the naive investors who are thinking of, Harsh is asking that if there are mutual funds that pay 10 to 11% annual dividend, and do mutual funds invest in securitized receivables like car or credit card loans?
Yeah, definitely yes. I think it's securitized paper, which is called as the PTC, we call it the pass-through certificate, which is nothing but a collection of receivables, either
with a cash flow,
with the cash flows, either on account of lending against two-wheeler borrowing.
So principal and interest repayment coming in the form of
comes in of EMI, whatever the EMI that is being paid, that EMI comes into the form of discounting. There are instruments which of course picking up, which predominantly is high in the case of home loan finance, as well as car loans and so on and so forth, which is called a PTC. But again, their interest rates are, as the person is asking, is not about 10 or 11. It all is AAA at the end of the day.
Okay.
So it all will be linked directly to the GSEC plus a few basis points, except the liquidity premium will be added to that.
Okay.
But I think those instruments are now becoming quite popular for the money manager to own as a part of the overall portfolio constructions. So from an investment point of view, I think what he gets is the 10-11% kind of things. From a return point of view, if the underlying investment doesn't earn so much, the 10-11% will not come. So therefore, I think one of the principles we always apply in mutual fund, if the portfolio doesn't earn more than say 9 to 10% kind of return, then there is absolutely no reason why the money managers should actually target to give 11% return to the investors in the form of dividend. That's something you should always be curtailed only to the extent of what you earn in the portfolio. So that's something which I think all of us follow, and therefore the investor also should keep the expectations lower when it comes to the question of this kind of return expectations.
Yeah, so I would just like to add to this thing what you're suggesting, that derive the return in the form of a withdrawal to the extent your fund is earning. That is the more tax efficient way of deriving return from a mutual fund, because if you are looking at dividend has suddenly become the most inefficient way of deriving return from mutual fund, and sometimes the dividend may not be the real gains, because you can invest in a fund, and the fund, if it pays an annual dividend, and if you invested just before the payment of the dividend, you will be effectively be getting your money back, and you feel happy that your fund is generating return. The fund is not generating return, it is returning your money back, and the principal goes down in value. So look at it little carefully, understand this, derive the return in the form of a withdrawal, which will be more tax efficient from here on, from all kind of funds.
True.
Not just equity and not just debt. So thank you, Bala, for answering all these interesting questions of wide range, basic to very sophisticated ones, and I hope to talk to you once again when we have some big thing happening on fixed income.
Sure.
Thank you very much for your time.
Sure, my pleasure. Thank you.